Hey, good afternoon, everybody. I'm Tim Fuchs with the National Council on Independent Living, and I want to welcome you all to our latest SILNet teleconference, Applying Your Indirect Cost Rate. So today's presentation is brought to you by the ILNet, of course, and the ILNet is operated through a partnership among ILRU, Nickel, and April, with support for the project provided by the Administration on Community Living at the U.S. Department of Health and Human Services. Um, John Heveron and Paula McElwee have proven to be a really competent and fun presentation team. Accounting maybe not always fun, but John and Paula bring as much excitement as possible and certainly a lot of experience and real-world examples. So from our more comprehensive financial courses to these very specific things around the new rules around indirect cost rates. They've just been so helpful, I know, for all of us. John is from Heveron and Heveron's CPA in New York. John's worked with centers for years, for decades actually, and so that's really given him the experience of the ins and outs of SILs and the regs. And Paula, of course, is the technical assistance coordinator for ILRU and has been involved in IL for years as well. So with that, I'm going to turn it over to Paula and go ahead to the next slide and we'll get started. Paula?
Great, Tim. Thank you so much. As Tim said, the evaluation information will also be at the end, but we know that you may have questions. We do have our email here as you go back and take a look at what we present. You may have additional questions or that will come up, so please drop us a note in the email and we'll make sure that we answer that as well. Let's look at slide 4. So what we're going to cover today is the practical aspects of actually applying your indirect cost rate. So earlier in the year, and if you didn't see these, you can go back, they're archived. Earlier in the year, we described why you would want to have an indirect cost rate, and we described how-to that was a PowerPoint that actually was the pieces of an indirect cost rate proposal. But now most of you are applying an indirect cost rate, and you began to do that October 1 with this new fiscal year. And now the questions that you have are more around the practical aspects of applying it. So we've heard those questions, and we decided this would make a great topic, so here we are. We're going to talk to you a little bit about how you prepare drawdowns and vouchers using your indirect cost rate. We're going to talk about what documentation you should have and keep in order to draw down your funds or to build the state for your funds or both. We're going to talk about how to determine whether you are on target with your indirect cost rate and what to do if you're not. What to do if so what you submitted is very different from what you're finding in your day-to-day application. We're going to also talk about what will happen if your provisional indirect rate is too high or too low. We're going to talk about how to simplify the annual indirect cost rate reporting, which is coming at the end of this year. So for most of you, anyway, that's the case. And then if you elected the 10% de minimis rate, what that means to you, how that's going to affect you as you go through this. And we do recognize that some of you who receive state funds only are being told by your state that you do not need an indirect cost rate. We're not really going to address that in detail here, but we recommend that you still look at that indirect cost rate, so we would like to help you work that out if that's the case, if you're still using a cost allocation plan with your state. And everybody else should be on an indirect cost rate or a de minimis rate. Let's look at slide 5. John, why don't you take the lead on this one? I love what you said here.
Thanks, Paula, and thanks for the introduction, Tim. First, I just wanted to say that we know this is complicated, confusing stuff. Some oversight agency folks struggle with this themselves. We want to help you avoid any problems, any loss of funding. We want to help you defend the indirect cost rates that you're claiming, and we will tell you to the best of our ability how to do that. So one of the first things we want to point out is that your final rate will be different from your proposed rate. You got approval for a formula. You did get approval for a provisional rate, but that really wasn't, that's not your final rate. So you're going to get a final rate for your year that began October 1st that will hopefully be close, but will almost always be different from your provisional rate. You may do some calculations during the year to see if you're on target. I would say that your indirect cost rate will always be wrong. One reason for that is because some costs aren't incurred uniformly. Insurance may be one bill a year, or you may pay that in payments, but not throughout the year. Summer is a heavier vacation time, so you have a lot more leave cost and less direct payroll costs. And your annual audit or preparation of your 990, that's a cost you incur really just one time a year. So if you were to add up all of your indirect costs, compare them to your direct costs, they would vary. They might be higher in the summer, lower in the fall. That's normal. But after year end, you will need to put your actual final numbers into a spreadsheet and recalculate your rate. HHS will review that rate, review your updated spreadsheet, and approve a final rate for this past year and then a provisional rate for the coming year. And they should generally accept what you submit as long as you prepare it in the same way as you prepared your indirect cost rate proposal. The final rate will be used to determine whether you've overbilled or underbilled. Next slide, please. So you can't bill more than your approved rate, and you really shouldn't bill less unless there have been some significant changes. I'm not talking about these little changes that occur during different months of the year, but really some significant changes which will ultimately reduce your overall rate. If it turns out you did overbill, you may be required to pay that back, or your future rate may be reduced. I'm hedging here. I don't know the answer. My experience generally is that if you've overbilled and it hasn't been too significant, you won't be required to write a check out to reimburse that, but your rate for the coming year will be reduced so that by the end of the subsequent year, you will have reduced your recapture of indirect cost by enough to offset the overbilling. But we're going to have to wait and see how that plays out. If it turns out you underbilled, they won't write a check to you. You may be able to adjust your future rate to catch up. This is new for all of us, so we will learn together. But just keep in mind that's a possibility. If you find you have not billed enough, then you should ask for an adjustment to your provisional rate for the coming year to catch up with the costs that you were shorted on. I also wanted to mention that there's a rule that prohibits charging something both as a direct cost and then also as an indirect cost. It's a very specific rule in uniform guidance. So you can only ask once for a specific cost to be paid with your grant. You must be able to show what costs were included in your indirect and to confirm that you didn't ask for direct reimbursement under another program for the same cost. Next slide.
And John, we put in this slide for questions and answers because this is so foundational, the two slides we just covered. So we want to make sure that they're clear. So Tim, we'll let you pull in any questions.
Sounds good. Okay, first question comes from Kelly, who is wondering, will you differentiate the bases and impacts?
And so I may need to get a little bit of clarification on that, but when you're talking about bases, I assume that that's the base that you divide your indirect costs by. And we will talk about this a bit later, but if you have an indirect cost rate, you have chosen a base. It might be total direct cost. It frequently is, probably most frequently is total direct cost. But it might also be total direct payroll. Whatever base you selected, you need to stick with that. So I don't know if that addresses the first part of your question. I want to scroll back up and see it was a two-part question. So I'm not sure what you mean by impacts. So if you can maybe come back with what you're looking for there, maybe we can help. It looks like Kelly is typing.
So she says MTDC versus total direct costs with salary and fringe, etc. And then MTDC doesn't cover rent costs, question mark?
Okay, if you don't mind, we're going to cover that. MT, modified total direct costs, are what a de minimis cost rate would be based on. We're going to talk about that near the end, and we really will get into that because even though this is about indirect cost rates, we know some people have gone with the de minimis 10% rate, and we really want to discuss the impact and the options with that. So let's wait until then. We will definitely have another Q&A session where we can talk about that.
Okay, great. All right, next question is from Linda. Paula, Linda is asking, is there guidance on the lag time that will occur after December 31st when the report is submitted and the corrections need to be made?
There isn't. And one of the biggest challenges for both John and I and all of you has been that there isn't a single office that is giving us guidance on this. So ACL is using their regional offices to provide us with information, and the letters that you all are getting are not the same one to the next. And the guidance that's coming from those offices has varied a little bit too. So with some people, there is more negotiation to their negotiated indirect cost rate than there is with others. Some are very quick to just kind of look through the paperwork and say, okay, it's provisional anyway, so we'll approve it and then we'll take a look at it at the end of the year. But right now they're not giving us any guidance, and some of you even got a letter that gave you a longer period for your provisional rate. So your date may be 12/31/17, but your date may be October 1, or it may be next year sometime. So you look at your letter to determine what the actual date is. We hope as we get closer to that date that we can tell you more, but right now they have not given us a single set of guidance, and right now the various offices are treating this slightly differently. So sorry, we don't have an answer on that one.
Okay. Well, thanks for the explanation anyway. Oh, go ahead, John.
Let me add to that my experience with other organizations that have indirect cost rates, even in those cases, the amount of time from the end of the year to when you have a final indirect cost rate can vary quite a bit. And it isn't really based on the complexity of your agency necessarily or how quickly you get things in, but it's even based to an extent on how quickly the federal agency gets around to reviewing these things. And because there are so many new ones this year for HHS, I think there may be a longer lag time, particularly this first year. Having said that, if you do a proper computation of your final indirect cost rate for the prior year, and an assessment of whether there are going to be any big changes going forward, and particularly if you assess there aren't really big changes, then it makes sense to continue with the same rate during that interim time frame.
Okay, great. Thanks, John. All right, next question is from Corey. John, Corey is wondering, how do we approach drawdowns and reporting if our direct costs are more than our grant amount?
Um, okay. Well,
Yeah, I'm
then
kind of trying to figure it out. Yeah.
Yeah, I think you're in a situation where you're not fully funded for this program, uh, and and um, and you're looking to some other source, whether it be contributions or another funding source, to cover part of the program, and that's a very practical reality for a number of organizations. You still need to go through the calculation. You still need to assess what the total costs of the program are. And the one little benefit that you get if you're, let's say, you have a 20% indirect cost rate, but you're limited to $100,000 and your direct costs are $110,000. Well, all you would need to prove for this program is that 80,000 of it, and my math isn't working out quite properly here, but you would not have to provide proof of direct costs for all of that. You would only need to have proof of direct costs for the 80% of it that's direct. The 20% that's indirect, you wouldn't need proof for. But you're not, you're probably not going to get any more funding if you're limited to $100,000. And so the question becomes, do you have additional funding so you can run that program at its full level, or do you need to reduce the scope of the program?
Okay, all right, good guidance. And finally, John Mona is wondering, is our approved rate only applied to the base we've selected?
Yes, it's very hard to get a change in the base. So if you selected total direct costs, then it's always going to be total direct costs. If you selected direct payroll, it's always going to be direct payroll. Very, very difficult to change that. But keep in mind, the numbers in the base keep changing. So all you're really committed to is that formula, that process of dividing these indirect costs by the actual numbers that are in your base year after year. So you're not bound by a number, you're only bound by a process.
And that's so important, isn't it, John? A lot of the questions we get have to do with people worrying about the fact that their numbers aren't exactly what they submitted, that they didn't really submit only the number, they submitted how they would come up with that number, and that formula has to apply no matter what, and it will vary.
Yes, absolutely.
Vary. Yeah.
Yep. Yep.
Okay. All right, well, we have 3 more Q&A breaks during the call, so I'm going to go ahead to slide 8 and turn it back over to you all.
Thanks, Tim.
Take this
go ahead.
one. You know, when someone comes on site to review you, and that might be your state people, it might be at some point in the future the folks from ACL to take a look at what you're doing. It may be that you're going to be reporting from a paper standpoint. It may be that your audit is going to look at this, but you need to make sure that you have an electronic file. You can have a paper file too, but we suggest that you definitely have an electronic file where you keep all of the indirect cost rate conversation. That would include your original proposal and any documents that were based on that proposal. So you've got your supporting documentation with your proposal. It would include, of course, your follow-up submissions as you get these notices to give the actual rate. So you're going to want to, anything you submit to HHS for related to your indirect cost rate would be in that folder. Also the approval from HHS, you know, they're going to be approving or have approved hopefully your first rate. Eventually will approve a second rate. So you certainly want that final rate also to be there. And then the spreadsheets you use to calculate any of this. So your Excel spreadsheets or your other spreadsheets that were used for your calculation are going to be very useful for your funders if they come in and take a look, for your auditors, and for anything that you might do in the future to update your calculations. So if you haven't already done it, you really do want to keep all of this documentation in one place where it's easily accessed. So as your questions come up from anyone, internally, externally, you have in place, that kind of thing. So it's easy to get to. John, you want to do slide 9?
Thanks, Paula. So we're going to suggest that you don't wait until after the end of the year to find out if changes might be necessary. Particularly this first year, it makes sense to look at things at some point during the year. In fact, for many, if not most of you, you're going to be coming up on 6 months very shortly, and it might be a very good time to do an assessment and see if you are on target. So again, if you used your financial statements, specifically that statement of functional expenses from your annual financial statements, or that page from your 990 for your initial rate, you may want to go to whoever prepared it, your accounting firm, if it was prepared by an accounting firm, and find out what accounts from your general ledger go into what lines on that statement of functional expenses or on the 990. They call that mapping, where you take several general ledger accounts and map them all to an account in your financial statement there. And if you can, do a calculation of how your current rate compares to your approved rate, with the caveat that we know it's going to be different. If it's too high, if it's low, find out why. It could be just timing, as we discussed. You might have had an error in the proposal, in the calculation. Is it possible you understated your rate, or did things actually change because of new programs or lost programs? So do the analysis. 6 months really makes a lot of sense to me, and try to understand. It's going to be different. It shouldn't be really dramatically different, but if it is it timing? Is it because of true changes? And follow through with that now, because it'll be more of a problem if you don't address it right now and make some corrections. Can we go to the next slide, Tim? We talked about modifications to the general ledger in the past. And Paul, I don't know whether you have any thoughts on this too, or whether you have any more practical experience than I do, but I think it helps a lot for people to reduce the number of accounts just to make this more manageable. I don't think most funders look for an excessive amount of detail. Group or combine accounts that don't have a lot of transactions or don't have a high dollar value. Most general ledgers allow you to go back and get those details. So when you combine 4 or 5 small accounts, it's not like that detail is lost. If you use QuickBooks, which I think probably the majority of people do, you can just double click and get the details of the different things that are in those combined accounts. So you haven't lost that detail, you haven't lost information, but it becomes more manageable when you combine things.
And John, I might just mention that one of the things we see, if you have someone who's not really as familiar as they should be with QuickBooks, they can also mess this up really quickly. So they can go in and not see the account they're looking for, and they create a new one, and then you've got this really complex stuff happening because they were not well informed. So from the very beginning, make sure you know what your accounts are and your sub-accounts or classes or however you use that. And don't be afraid to get somebody who's pretty expert in that to help if your bookkeeper is not. Because if your bookkeeper is not, it can be quite problematic as they begin to do entries if they're not familiar and sticking with your sub-accounts and classes and accounts. And I have seen that so many times, it doesn't take very long for somebody to kind of make a mess of that. So, coach whoever you have coming in to write the checks, especially if they're not somebody with the actual experience.
Yeah, I agree with that. That is time really well spent to get somebody with some expertise to get QuickBooks down to a manageable level. If when you buy QuickBooks, even if you have QuickBooks for nonprofits, QuickBooks Pro for nonprofits, they have an extensive number of accounts built into it. You need to modify that down for your circumstances, because if you have several different accounts that sound similar, you're going to have the same type of expenditure in different accounts at different times. Also wanted to mention that in addition to having a proper breakdown between what's really direct and what's really indirect, keep in mind that there can be minor items, small costs, maybe a lot of transactions, and technically they might be direct. They might be directly allocable. But it will be more efficient to treat them as indirect and pool them with other indirect costs. So that'll save you time and make this process more manageable.
And this might be a good point at which to mention that sometimes doing that does give you a little higher indirect cost rate than you might have had otherwise. And your funders may be looking at your indirect cost rate. We're finding this in some states where they're seeing it as an administrative rate instead of as an indirect cost rate. And an indirect cost rate will typically be higher than your administrative rate because you've got some of these shared costs that might be technically direct, but it makes sense to pool them and have them be included. Examples would be things like phone and photocopying and office supplies that you might, in another day, have divided out and made everybody sign up for everything with their own little sub-account. And now you find, oh, it doesn't make sense. We ought to just put all our phone as an indirect cost and share it back out based on our formula rather than have people, you do it another way. I don't know if that's a good example, John, but it seems like we used to have codes on the photocopier. But that doesn't make sense.
Exactly, and track phone calls and the like, and now I don't think anybody's going to opt for that. So, yeah, good point, Paula. So whenever you add an expense account, and sometimes there are legitimate cases where you have a different type of expense account that you haven't incurred before, but be thoughtful about whether it's direct or indirect and make sure it goes into the proper grouping. And I guess I would add to that challenge whether you really need to add another account. If it's large but infrequent, can it be combined with a miscellaneous account? If it's small, again, can it be combined with another account? And next slide. So we've talked about doing this in the preparing for your indirect cost rate. So I know this is territory we've covered, but if you haven't done this already, you're probably feeling an impact or will feel an impact when you try to do your initial calculation of how your indirect cost rate is going. So if you haven't set up sub-accounts or classes or groupings in your general ledger, consider doing that. And one of the groupings should be for indirect cost. So you're going to have an account heading called indirect cost, and under that you're going to have different types of expenses. You would have some of your payroll and payroll taxes, insurance, office supplies, your outside CPA costs, things of that nature. So all of those accounts would be in the QuickBooks world, we call them sub-accounts. They'd all be sub-accounts of indirect costs. That means you haven't lost any of that detail, but now you've managed to combine all of these together. And I'd also like to suggest that you add another account, an income account under indirect costs, where you just put in there how much you have billed for indirect. And so rather than put expenses into indirect and then take them out or reduce them when you bill them. Just have another account, a revenue account for your billings of indirect. And then you'll actually have a running track of how your billings of indirect compare to your costs for indirect. And that may generate a question or two. I know that's a tough concept, so we will deal with them when they come up. But not my expertise, but I talked to our QuickBooks person, and this is what she said to do, to set up sub-accounts on QuickBooks here. And it's on the list. I'll just go through it quickly, but you select lists, chart of accounts, and then account on the bottom of the screen. You highlight an account and select new or edit, and you right-click on an account, for example, insurance, and then you check mark it and make it a sub-account, and then it'll say a sub-account of what, and you just find indirect. So that's how you would make it, how you would make insurance a sub-account of indirect in QuickBooks. We can't address all of the different general ledgers, but if you have any sort of capability for groupings, there will be a process similar to this. Paul, any other general ledger procedures that you're familiar with, or?
Not right there, but I think this next slide might be helpful for the conversation because it's also a place where you're dividing things out. And that's slide 12.
Yep.
And it has to do with our cost objectives. Now, I'm going to take y'all down memory lane to remember what a cost objective is. Because there was a time a few years ago where cost objective was almost always interpreted as a funding source. But the new uniform guidance and uniform administrative requirements are very clear that on exactly what a cost objective is. And it has become very clear that you can combine multiple funders into a single cost objective. Now, most of our conversation around this had to do with staff time. And we have some training on that, and we can go over that more later. But if this sounds familiar, it's because we talked about it in how you divide out staff time on your timesheets. But the idea is that all of your costs should have a cost objective that they're attached to. But sometimes the cost can be from multiple funders. The most common example here is if you receive both Part B and Part C money for independent living services. If you're serving the same people, all disabilities, all ages, which are required by those grants, and you're doing that in the same general geographic area, it's not only not necessary that you divide out your time and your other costs by grant, it is also almost impossible because you are doing exactly the same thing, whichever grant you're working on. And most of you found if you tried to do it by funding source, most of you found that you were doing it artificially. You were making up a percentage to split it out that fit with your grant application, but not based on the actual time or the actual things that people were doing. So if you have a single cost objective with more than one funder, you may not want to break those costs out by funder. It's not necessary for you to do that except at the time that you apply for your funds, and when you draw down you need to know how much of each you did. So the expense accounts that you voucher will help you calculate each funder's share, and that is sufficient. You do not have to split them all out at the time that you're paying the bill or at the time that you're looking at your costs. You can certainly combine them if it's a single cost objective. Now, in some ways, this is more complicated than splitting it out by funding source. But I think in the big picture, in the long run, you're going to find it much easier. Don't you think so, John?
Yeah, I agree, and particularly once you go through the process once or twice, if you keep those costs for that single cost objective together in your general ledger, and then when you're ready to bill the cost to one or both funders that apply, you might transfer all of those expenses to an Excel spreadsheet and multiply each one of, now this is, we're talking the direct now, but multiply the direct expenses like payroll for that entire cost objective by the percentage that each funder is covering. So if one funder covers 60% of the cost of the program and another covers 40, you've got $10,000 of payroll for this time frame. Then $6,000 of that gets billed to let's say Part B, and $4,000 to Part C, and similarly with all of your other direct costs. So once you set that up, many general ledgers will allow you to send a group of accounts or send a report right to Excel. Once you get that Excel spreadsheet set up, it'll be fairly easy to get a total for those direct costs for that time frame, and then just multiply them by each funder's share. And keep that spreadsheet. That's important documentation for you. To show how you went right from your general ledger to what you were drawing down or vouchering for.
Let's look at slide 13. Some of your funds are also pass-through funds, and we treat them a little bit differently. So some examples would include community development block grant funds that the county has, and they're granting them to you for helping people have accessible homes, and so, you know, somebody's building a ramp or whatever, but you're passing that money through directly to the consumer. Equipment loan libraries is another one. Sometimes people get transportation passes for the purpose of teaching the independent living skill of using that public transit, and so they have those passes that you can use during that teaching time, and the cost of those passes is actually passed on, or the benefit of those passes is actually passed on directly to the consumer, and it isn't a cost that that you actually end up administering, except for just passing it on. So if your indirect cost rate proposal, you could actually propose to treat these costs differently by allocating less indirect cost to them if you did that in your indirect cost proposal. And I know some of the proposals that I looked at actually removed these from the calculation for the indirect cost rate. And they said these are not things that have an indirect cost applied because they're pass-through funds. John, what do you think about that process?
Well, putting nothing on it is a little harsh because you certainly have responsibility, you have accounting and oversight responsibility. What some funders do that provide money to other agencies that pass these monies through is to limit the indirect to 10%. That's pretty arbitrary. It's not like the 10% de minimis, but they just say in applying for an indirect cost rate, we want these treated differently, these pass-through dollars. Having said that, if you didn't do that in your proposal, you really can't do that now. You can't change how you're doing this unless you get some feedback from HHS that they're not going to allow the full indirect cost rate on pass-through funds. Then that would force you to modify the rate. You'll just have to make it up in other areas, and your rate in other areas would go a little bit higher. But if you prepared your indirect cost rate proposal treating pass-through costs just like any other direct cost, you need to stick with that. You can't initiate that change. Okay.
And that's really a sticky place, I think, with a lot of our centers, because there are some of those funds, and I think it's been inconsistent how they were treated in the different proposals that were out there. But yeah. Otherwise, you just have to apply that same indirect cost rate to everything, and that's the intent, is that you're applying that indirect cost rate to each and every thing that comes through your center, unless your proposal allowed you to do it differently. About
You know,
14.
Paula and I are learning here too, and we're going to learn from feedback from you. So as you have experience with this and all of these areas, it really helps to share that. Paula, are you still doing a blog or?
I do. I do a blog,
Yeah.
and when anything new comes up, and you talk to somebody at your HHS office and they give you specific feedback, let's talk about it because it may be beneficial to everybody else to know how that's going to work. Because I noticed one of the people who's dropped a note in the chat said that they are supposed to send their calculation around their indirect cost rate at the end of this month. That's what their letter said. Oh, wow. You know, so you may be the first one to know some things about how that process works. So please let us know because there is, like I said before, there is not consistent treatment of it from one office to the next, and we really need to learn from everybody. So, so that's very helpful.
Yeah,
I think we're ready for slide 14.
Yeah,
Sorry.
and by the way, that's a very interesting request, Paula, because presumably it's going to be less than a year, and so the rate will be skewed to some extent. So yes, we'd love to hear back what the result of your submitting that information is.
And there were a couple of comments on that in the questions. We're going to have questions in just a minute, but we really can't answer that one. Your regional office is going to have to tell you exactly what deadlines you have related to your proposal because they're not uniform.
Yeah.
So, okay.
Okay, so on slide 14, you may not, you need to keep an electronic file of documentation for drawdowns and vouchers. You might not need to submit it. You probably don't need to submit it, but you need to have it. You know, some funders may require this immediately after a request for a drawdown. Some may come in and audit your organization a year or so down the road, and you need to have this information. So this is a second electronic file of your vouchering. Keep everything that goes into your calculation, and just you know, keep files or folders for each drawdown. And if you're required to provide additional details for your indirect right at the time, well, if you have a general ledger grouping for indirect like we were talking about earlier, you will be able to voucher for a portion of each of your indirect costs. But in most cases, you should be able to just voucher for indirect based on your direct costs, keep your documentation for that. Best if that documentation starts with the general ledger. It won't exactly come from the general ledger, but it should start with the general ledger, and then it will be analyzed, for example, if you have multiple funders for one cost objective. So you'll start with your general ledger. In that case, go through an Excel spreadsheet or some other sort of analysis. But always try to start with your general ledger. That way, you're sure you're not missing anything and you're not duplicating anything. And of course, you know, you should have all of the details of payroll taxes, supplies, and other direct costs. And that's 14.
Let's look at 15
Yep.
before we have our next break.
Okay.
So that same file, this is continued. Make sure you have all your calculations in there so that you know exactly how you did your calculations, including your base. And your base is determined by your proposal. So remember, it may have been all of the direct costs. It may have been based on direct payroll specifically as your base. But whatever you said in your proposal is what you do. So you follow your own formula in doing this. If you don't have proper documentation, you do run a risk of being asked to go back and submit all of your receipts and expenses for each drawdown. That's usually the procedure both at the state and the federal level with your grants if you're found to not be in compliance with any of this. And so then the next step is to go back and have you submit all of that documentation with each and every drawdown. So you need to have it there back you up so that people can see it if they come in to do an on-site review, so you can provide it to them if they do a remote review. But you certainly want to make sure that that you have all of that in place. Some funding sources also prohibit you from taking any advances, so they're based on your actual costs as they happen. And that's true with your drawdowns. You should be basing them on your actual or anticipated in a very short period in the future, the actual costs that you are going to incur, the checks you're going to write. As you do your drawdowns, they should be related back to both direct and indirect costs, and you should be able to see all that in your documentation.
And we've seen that. We've experienced that with some agencies. It's unpleasant. It's a lot of work. It will definitely slow down your cash flow. It really can create a serious cash flow constraint, depending on the level of detail you're requested to provide and the level of review the funding oversight agency intends to do. It may really slow the process down for getting reimbursed for cost. So you want to avoid that at all costs. And I think if you just keep good documentation for what you did, that's less likely to happen. And looks like we're ready for some Q&A here.
Yep.
Sounds good. All right, here we are at slide 16. So we've got a good list of questions already that have come in during the last segment, so I'll start with those in order. Nicole and Michael both have essentially the same question, and I'm going to toss this to you first, Paula. Basically, they received a statement that their rate was approved until September 30th, 2018. But then received notice that their next proposal would be due March 31st. So do they need to submit their next proposal on the 31st of this year? Should they contact the regional office? What would you recommend?
I would recommend that you contact the regional office. I'd also recommend that you compare the two letters. Once in a while you'll have a situation where it's not from the same person, and so they're actually not asking for exactly the same thing. So you want to double check, make sure that you're talking about the already approved rate, and make sure that the dates are right. That date doesn't look right. I mean, it seems very soon. You're only 6 months into the use of the new rate, and your rate was good for a 2-year period, so it seems too soon. But I think you need to call the person and talk it through with them. That's the only way we'll know. And then let us know what they tell you so that we can learn. Okay,
good. All right, John, my favorite question so far, and I'm not picking on him, it's a good one, comes from one of our guests that didn't list a name. They said, how much does my rate have to be off before I should be concerned?
And boy, that's a tough question to answer here. It's very, very dependent on the size of your budget and how it would impact the organization. I guess the best answer is if you calculate that there is a difference, apply that to your total indirect cost rate, and you come up with a number that is a concern for you. Whether it be a potential overbilling or a potential underbilling, then at the very least you should do some investigation. As we've said from the start, there's going to be a difference. So small differences, maybe something within 1 or 2 percentage points may not be material for most agencies. Although, if you have a large agency, 1 or 2 percentage points, 1 or 2% of your direct cost is still going to be a fairly big number. So I can't answer that specifically, but I guess that is the approach I would take, is to see how the projected difference would impact your agency.
Okay, great. All right, Kelly is wondering if, she says the base dictates how things are applied. So I'm wondering if you all will differentiate the differences between bases, and I'm adding as that would impact the indirect cost rate.
Well, again, that question, I guess, is most pertinent to somebody who's making, who's still in the process of determining whether they're going to do an indirect cost rate proposal, because you really don't have any choice once your proposal is submitted and approved. What we do recommend, if you're in that situation, if you're still evaluating it, is to calculate how your funding would be impacted using a total payroll cost, total direct payroll as a base versus total direct cost, or possibly even some sort of a hybrid. I will tell you that as several agencies were doing this, a couple looked to us for some help, and we found that there actually was quite an advantage to a couple of agencies to go in one direction or the other. In other words, to check direct payroll as the base versus total direct cost. They actually would get more funding from their federal source. They had another program that wasn't federally funded, and they were really struggling with funding for that other program. It still was legitimate. It still was appropriate, and it was approved by their federal agency, by HHS, but it worked out better for them because it required less indirect to be applied to this non-federal program.
Yeah, and the main thing to remember is you are stuck with your proposal, whichever way you did it. Now, I know that a lot of you are the fiscal people at your organizations, and you're very concrete thinkers, and you like to see things be very precise and accurate, and that's why you're so good at your jobs. So I know this is a little uncomfortable. It is for all of us to think, okay, we're talking about this, but we still have a lot of choices we can make. And there really were choices that you could make at the time you did your proposal, and if you've not done a proposal yet, as you approach that, about how you do your formula, the base being part of that, or a big part of that. But I know it's not comfortable, huh?
All right, thanks. The next question comes from Brenda. And I think I've got the wording here, but maybe you all can help me decipher this. So Brenda says, pass-through funds that CDBG, Community Development Block Grant, requested for the federal match to cover indirect cost. But I was told that might be a big no-no. Can you tell me if that's a possibility to cover the indirect costs for a CDBG?
Yeah, it's handled differently. While that's HUD money and it's federal and it's passed through usually your city or your county passes that through, the city and the county make some of those rules. And so you need to look at that. But when you have an indirect cost rate, you really are expected to charge those indirect costs to all of the different funders, even if they aren't ACL. So ACL is who required you to, the Administration on Community Living in HHS, Health and Human Services, is who required you to have an indirect cost rate. But the reality is once you have an indirect cost rate, you should be able to apply it to everything you do. We even talked to you about applying it to your fundraising so that you can keep track of all your actual costs, not just your direct costs related to fundraising. Or we suggest that you do it related to lobbying, because we know you do some lobbying or may do some lobbying with discretionary funds. Well, the indirect costs related to that need to also be charged to that pot of money. You can't charge it back to the federal pot of money because they can't pay for lobbying. So you are in a situation where you are expected to apply it to everything. If that funding source won't pay that cost or won't allow that cost, then there are a couple of ways you can approach that. Of course, one is you may have to pay for it with discretionary funds so that every cost objective is having its own share of indirect costs, its fair share of indirect costs. So you may be needing to do that. And the other possibility is you may need to negotiate with the funder and say, okay, I'm going to identify these as direct or indirect, but I'm going to put them back in the actual line item of the budget. So I'm going to put the portion of my administrative salaries that are indirect back into the salary line of my budget, and my budget includes both direct and indirect. John, have you seen any other solutions to that dilemma?
No, and I have to agree with what you just said, particularly about the administrative salaries. I think that's the proper way to handle it.
Okay, great. All right, Sally is wondering, some of the grant applications we prepare, United Way, for example, require expense line items. So, John, would you suggest including a line for indirect cost rate, or calculate how much of that rate is for rent, supplies, etc., and including them in the expense line items?
So let's see. So we're talking about non-federal awards. In fact, Sally is mentioning United Way. You probably do need to list the individual components of your indirect cost rate for an agency like that. Now, you might be able to say to the agency that we're federally approved for an indirect cost rate. Here is how we calculated it. Can we just provide that as a percentage as we do to our federal funders? But normally I would expect that they would want to have the details. They would want to have each of the components of the indirect cost.
Okay. All right, great. Okay, again, for you, John, Barb is wondering, if you check the sub-account and choose indirect, is there a way to introduce the approved percentage rate formula for it to calculate correctly?
To the best of my knowledge, there isn't. I don't know that. I don't know that there's any way that could be built into QuickBooks, and I don't think it could be into other general ledgers. I think all you can do is to use your general ledger to gather and combine your costs for a specific time period. And then you have to do those calculations manually or set up a spreadsheet to do them.
Okay. All right, thanks. All right, Paula, Linda is wondering, she says, in the past we haven't included the estimated indirect cost rates in our budget proposals to the DSU. This year we're experiencing costs not budgeted at the beginning of the year. Is it acceptable to add a new cost line item to include indirect costs?
And this is, I think, a two-part question. And the first part is, can we bill our indirect costs to the DSU, or we're now calling it the DSE, the designated state entity that passes the money through? Is it okay to include indirect cost rates? And we're finding that the different states, the different DSEs, have different policies around this. And some of them don't have anything for indirect costs, or I've talked to one center where they said they actually blocked it out so that you couldn't write anything in that line for indirect costs. Well, you need to have a conversation with them about that. All of your entire state network may need to want to do that, so that you're all on the same page related to the fact of whether or not they allow you to apply the federal indirect cost rate to your funds. Typically, they are supposed to. So typically, you should be able to have this conversation and clarify that an indirect cost rate is not the same thing as an administrative rate, and see if you can make that work. But if you're experiencing costs that you didn't budget for, you do need to be watching how that affects your indirect cost rate. And you may, yes, you may need to add cost line items, but that policy varies so much from state to state. We really can't advise you on how you do budget revisions or revisions to your indirect cost rate, because it's going to vary It's going to vary quite a bit. So your state may say to you, oh, you're only allowed to do 2 revisions a year, or they may not care, and they may let you revise your budget every month when you redo whatever. So the different states, the different DSCs have different policies, and you really need to ask them how they want you to treat that. But once you have that additional cost approved, your full direct costs are, or your salary related to your direct salary related to your costs, whatever you had as your basis in your proposal is what you apply.
Okay. Yes, and let me just add, right in uniform guidance, there's a pretty clear mandate for federal funds fully covering programs that they're in other words, covering the direct and the indirect costs of the programs they are funding. And while that's not directed to the state agencies, in a way it is because they become pass-through entities. So they're really bound by uniform guidance as well. You can't just throw it in their face, but you might, if you can put together a meeting, it might be good to share this and ask how they've interpreted it, or how they will deal with that, or how you need to provide information so that this can be done.
Okay, great, thanks. All right, and back to you, Paula. Lydia asks, they have a rate agreement from HHS that lists the effective period as starting April 1, 2016, but she's asking, are we not supposed to apply that rate until the beginning of the fiscal year, which of course is October 1, 2016? How would you apply that?
Yeah, there's a little point of variance here that might happen based on your proposal. Some of you in your proposals actually gave a starting date. So if your proposal says we're going to start this next fiscal year, which was, of course, we've already into the beginning of that year now, but October 1st, if that was your proposal, then that makes the most sense. If that was not your proposal and they gave you a date, then you probably really are responsible for applying that indirect cost rate from the date that they gave you. John, is that how you'd see it? I'm not sure.
Yes, but we're going to learn as we go through this first round. So that's what we believe at this point in time. We really do want to get your feedback as we're going through this.
Yeah, so if any of you make that call to your regional office or drop them a note and ask for some of the answers to the questions we don't really know, we would love to know what you learn. It would be very helpful to everyone.
Okay, great. All right, let me get in this last question from Kevin before we go back to the slides. Kevin asks, John, what is the difference between indirect costs and administrative costs? We can see where unallowable costs could be administrative but not indirect. And he also asks, what is another situation where this may occur?
Well, to address the core question, what's the difference? Although we treat them as very similar, particularly for small organizations, small agencies, there are circumstances where an administrative cost, maybe an administrative person, might be directly charged to a particular program. So that's an instance where an administrative cost might be directly charged, and actually there can be a lot of those. We mentioned an example a while ago where smaller direct costs can be pooled and combined and treated like the administrative costs are treated. So by definition, direct is something that can be tracked to a single program or multiple programs, but not all of your programs. And indirect are things that benefit all programs in a relatively equal way. And so you can see that definition is a little different from administrative, which administrative is more of a supportive service concept. It supports your program, but it isn't your program. But as a very practical matter, most organizations are going to find that administrative and indirect are at least start out similarly.
Yeah, I find it useful, John, to say they aren't the same to get the conversation going when somebody just kind of blocks out the conversation of regarding a rate that's more than what they think is a good rate. So you'll find some of the funders might think that 15% is the most it ever ought to be. Well, it depends on how you deal with your different costs, how that should be. And somebody else will say 25, and somebody else will say, what do you mean you have a 40% indirect rate? And depending on how the different costs are handled, it may be very reasonable. And you can't just say, oh, that's too high or that's too low based on the number. You have to actually see what is happening in order to know that. So sometimes I say that it's not exactly the same to get the conversation going so that they can look at it more reasonably, especially when you're talking to funders who are objecting to your rate.
Okay, great. Thanks to you both. All right, I'm going to go ahead to slide 17. We'll wrap up these last few presentation slides and then take a final Q&A break.
Sounds good.
Paul, you want to cover 17 there?
I will do this one, yeah. Now, we've covered this before, and we have a whole training just on this issue of how you allocate payroll. And we're not going to go through all of that information here, but we want to remind you that you need to do this after the fact. So the documentation of how your actual payroll time is direct and indirect has to be determined after the time has taken place. So it's an after-the-fact documentation. We suggest using personnel activity reports. You can have different columns for the different cost objectives, including indirect, and you can then go in and check on those, and that's how you determine your payroll. If your payroll is your base, these become even more urgent to have them done properly. So make sure that you do understand how to do personnel activity reports. You know, it may be that we're not required to do it in quite this much detail. We're still interpreting the uniform administrative requirements as they've come down from HHS, but because there haven't been any on-site reviews, we really don't know how they will treat this issue of how you keep track of the activity of your personnel. So we're suggesting that you do it based on a payroll period or the full month or the 4 weeks of your payroll period. It's got to agree with your payroll period. But we're suggesting you keep track of people's actual time after the fact, payroll by payroll or month by month or 4 weeks by 4 weeks, so that you have an accurate documentation, and then that's what you use to determine if your allocations are proper with a number of things, including this indirect cost. And we've got a link there where you can go back and look at a little more detail about this. And we have sample forms and all that kind of stuff in our financial resources on our website. But do remember that payroll is a big piece of this, and you have to make sure your record keeping on payroll is accurate. We haven't seen this happening with any of our centers, but we did see a number of other organizations in the past who had costs disallowed because they didn't keep this record accurately. So you do want to make sure that you don't find yourself in that situation. If cost is disallowed by somebody who comes in and reviews you, that means that you have to give back the money, their money that you used to pay for it. So you don't want to get in a situation where it's disallowed. So we really recommend you use this payroll by payroll tracking system to know how you're allocating your payroll, and then check and make sure it's happening accurately. I think that's all on that one, unless you have something else, John.
No, I think that covers it, Paula. Let's go on to slide 18, and I'm hoping we answer the question about the 10% de minimis rate. If not, we'll come back to that. We'll come back to that question. But you know, it wasn't our intention to go into detail on the de minimis indirect cost rate here. this is really about how to deal with your indirect cost rate, but we do want to remind you that there's not a formal application process if this is what you've decided to go ahead with. You really just need to put it into your budget to elect the 10% de minimis option. And I also want to say, though, that we've talked to some agencies that chose this because of the complexity of applying for an indirect cost rate, and they express concerns that they're going to be under-reimbursed, maybe seriously under-reimbursed, and we believe that not many agencies will be able to operate with a 10% indirect allocation. And it's really not 10%. I mean, when you apply your indirect cost rate, you apply it to your base, either total direct cost or total payroll. With your 10% de minimis, you apply this only to what is called modified total direct cost. That's payroll and payroll taxes, materials and supplies, direct services, and travel. You don't apply it to equipment. You don't apply it to rent or facilities maintenance. You don't apply it to participant support costs. So you multiply the 10% only by the modified total indirect or direct cost, the modified total direct cost. And that really means it's not it's going to be less than 10% of your total direct cost, and it's probably not going to be adequate for most of you. So if you elected that method, the good news is you're not locked into it. You can still apply for an indirect cost rate at any time, but it probably won't be effective until the coming year. You're probably going to be locked in for this current year to your 10% de minimis. Although I probably shouldn't say that, Paula. What are your thoughts on that if somebody applies?
No, I think that you're pretty much right. And I have some concerns about those of you who might be doing the 10% de minimis, and maybe you could set our fears at rest, because the ones that we've worked with on proposals, they've come in at quite a bit more than 10%, typically double that or more. And we've found that that 10%, especially when it's applied to these modified direct costs, it doesn't seem like it could be enough, but maybe we're wrong. If it's working well for you, we would love to hear that too, because as new centers come on board, or as some of the organizations that are state-funded only shift over to an indirect cost rate, it would be helpful to know if some of you feel like it's really going well for you.
Tim, did we properly address that question that came up regarding this 10% de minimis? I think the question was about what it was based on. If not, we should revisit that.
Yeah, will you differentiate the bases and impacts? So I think that Kelly can let us know if there are still questions remaining. You addressed that a little bit more in the last Q&A break as well, but Kelly, please let us know if you'd like us to clarify anything more.
Okay, and then with that, I guess we can move on to slide 19.
And our summary.
Right.
So your indirect cost rate is a formula. Apply the formula as you described that you would in your proposal. So you chose your formula, and now you need to apply it. Measure your performance related to your indirect costs as part of your monthly reconciliation of costs. Make sure you know if it's high or low and why, so that you know what to do related to that. And keep the records. So important to know how you came up with your figures, in case you ever have to justify that, or in case you're going to decide later that you need some adjustments based on what you know now. So, other thoughts, John?
No, I think that covers it, but I'm sure we probably generated a question or two.
Okay.
So Tim, do we have questions? Yeah.
All right, let's see. So Kelly said no more questions at this time, so we've addressed everything that she wanted to know. Here's a question from Mona. Mona says, So we have a 23.7% indirect cost rate. Do we apply that only to salaries, since that's how the base was determined?
Well, if that was the base that was used, then the answer is yes. So you would voucher for all of your direct costs, but apply your indirect only to direct payroll.
That's assuming, of course, that you have reduced your other line items by that indirect amount. You can't charge both your 23.7% and 100% of whatever you had in your indirect costs are in your direct costs. So you have to make sure you follow your formula all the way through so that you're only asking for that once.
Okay, great. All right, and then several of our attendees are describing still feeling pretty lost, their words. So I would encourage you all really to start by, well, talking to your, certainly talking to your accountant if you're not already, or your auditor for some hands-on help. But also go back to the earlier versions of these trainings, where we talked about the introduction to the indirect cost requirement, where we talked about developing the indirect cost rate formula, and then you may even want to re-listen to this one after you've done that. So those are all available on the on-demand training page on ILRU's website. So now, if you've already done that and you're still lost, then please do let us know. Send in more questions or email me or Paul and John. But anyway, that's where I would start. What other tips do you all have, John and Paula, for folks to get more in depth on these answers?
Well, actually we've got that on these last few slides. We can go back to the questions and still show those if you don't mind. Let's look at slide 21. Has the federal resources that Health and Human Services provided. So they have 3 links there of things that they provided on how to do their guidance, first of all, and then a checklist for how to do the proposal, and then also an actual sample indirect cost rate proposal. So if they're finding themselves looking at their rate and kind of wondering what to do with that, you'll find those there. On slide 22, you'll find the actual link to our content on financial management. Some of that is an actual 2.5-day training that we did that's all video and all the PowerPoint and captioned and everything, and it's all on our actual website at ilru.org. So you'll find a number of different things there related to that, and if you would just look for financial management or CIL financial management on that page, there's lots and lots and lots of information there. Sometimes that's more information than you want. So sometimes it is helpful for you to write your questions out and then give me a call or drop me an email. I live in California, so sometimes the email works better for those of you who are on the East Coast just because of the time difference. But anyway, you can call or email me anytime, and I will look at your individual information. And then if it's kind of confusing to me, which sometimes it is, then I pull John in and get his help so that we can kind of make it make sense. Now, the interesting thing I'm finding, though, with all of these questions is I'm not sure who internally then did your proposal. So if you have a rate and you have had it approved in your proposal, then I'm hoping that you can go back to the person who created that proposal and get some answers about your individual differences there, because I would have to read through your entire proposal and get a handle on it before I could give you any other information about it. So if that helps to kind of think about that.
Okay, great.
And somebody asked how to reach me. I'll put my email and phone number in here again right now in the chat.
Great, thanks, Paula. And it's back on slide 2 or 3. I think it's slide 3. And then I want to offer my contact information too, because I said this about somebody else on a recent call too. John was generous enough to provide his email address, but for Paula and for me, it's truly our job to respond to your TA requests. So full time, Paula at ILRU, me here at Nickel, please, please, please let us know how we can help answer these questions day to day. That's part of our job with the ILNet project. Also, before I go back to these content questions, I saw someone else ask if we were going to have any face-to-face training, and that multi-day training that Paula talked about a moment ago was the last on-site that we had, and it's the only planned on-site. Speaking of grant applications, this ILNet project is a federal grant as well, and so that's going to be up for funding. So we can only plan activities through September 30 right now. So we would love to host another on-site financial management training. The last 2 that we've done have been very, very big. They've been very popular. So we know there's a need for it, but the grant needs to be continued first. So no imminent plans, but we know how much you all like those. So. Okay, let me go back to a couple content questions I saw. So Audrey asks, our Part C grant doesn't cover the full program. We use other funds to cover expenses. Our auditors are asking how we determine what portion of the expense gets applied to the Part C funds when we draw down funds. We're unsure how to address this. Staff wages are more than the grant, so we only charge a portion. How else should we justify this?
Well, this is sort of a mechanical question, but if you have a program that's not fully funded, you still need to record the full cost of that program, including direct cost and indirect, as part of that program. And if the result of that is that your expenses exceed your income, well, that is your reality. I assume that you have other sources for covering those costs, but you don't want to record only a portion of the cost of a program simply because you're not fully funded. You still want to show the total cost of that program and then what the different funding sources are.
And if the different funding sources are the same cost objective, that's your answer to your auditors. It's these 2 funding sources together, and these expenses specifically are a single cost objective. And we can give you more of a reference from the regulations and more information about that. But if it's the same cost objective, you can share the costs back and forth arbitrarily. You can just decide Part C will pay for this and Part B will pay for this. Whereas if you have different cost objectives, then you can only charge to Part C specifically what you said you would charge to Part C, and you have to separate it all out, time and everything else. So it's a lot more complex to separate it out than to keep them as a single cost objective.
Okay, great. All right, Karen says they selected the 10% de minimis. She says, our federal office, which I assume would mean the office that receives Part C funds, has its own direct cost because it's a separate building. Are we able to count that office's rent, utilities, maintenance, etc. as a direct cost? John, what do you think?
I'm not sure I understand the situation. So is the agency in a sharing a facility with another agency?
I paraphrased because I was trying to imagine what Karen meant. What she actually wrote was, our federal office has its own costs, parentheses, direct. And what I thought it meant at first was maybe she was, a silk that was in a federal building or something. But I think she's talking about this, an office that receives their federal funds. as opposed to maybe other offices that receive state funds. But maybe Karen can clarify for us.
She's typing something right now, so maybe she'll clarify that for us. But Karen, if you're talking about Part C funds having a distinct office and therefore can you charge those distinct costs as direct costs, the answer would be yes. So if you have costs that are not otherwise separated out, and she said, yeah, it's a standalone office for Part C, totally separate office, totally different county, so you can't consider it a single cost objective with whatever other counties are funded with Part B or other funds. So yes, it can be a distinct and direct cost as a standalone office. I can't see any reason to divide it out as indirect. I think there are administrators that you would divide out as indirect, but the actual office costs could certainly be direct, I think. What do you think, John?
I would agree, yep.
Okay, all right, great. And finally, Barb, kind of a comment or suggestion here. She says, we still use our old cost allocation plan document to distribute our cost to each grant. It works. So is that something that others could do if they have their CAP plan? How can you reasonably rely on that in this process?
Well, the first thing you need to know is that HHS required us to go for our federal funding, for our Part C funding, required to move from the cost allocation plan to an indirect cost rate. If your center is only funded by the state, then they can still allow a cost allocation plan. But for the federal, they're requiring an indirect cost rate. And John, you were going to say?
Well, simply that if you had a cost allocation plan, it had a lot of similarities to the indirect cost rate process, and so the part of it where you allocate indirect cost to direct cost may not have to change at all, but you do need to get approval for that. If you don't go in for an indirect cost rate, your only option would be the 10% de minimis. So you can't just continue to use your cost allocation plan, but you can submit an indirect cost allocation plan using the same process, the same formulas.
It's the last step, right, of actually deciding how to apply the formula is what's different. Yeah.
That's what I assumed Barb meant, which is why I phrased the question that way, because I remember you saying that on some of the earlier calls, John, that you could sort of use some of those calculations as a starting point and then go ahead to create the formula to come up with the rate. So, all right, well, this has been a great discussion. We're at 4:30, so I'm going to have to move to close. Luckily, we made it through all the questions. Thanks to all of you for being with us, and I just want to reiterate two things quickly. First, this evaluation link here on slide 23. And second, as you heard all throughout the call, we want to hear from you. So we want to hear the barriers, the stopping blocks. We want to hear the answers you hear from ACL and the regional offices, and we want your questions. So let us know how we can help going forward. But thanks so much for joining us today, and just please be in touch. John and Paula, I can't thank you enough. You all have done a really great job with the past trainings, from webinars to the on-sites, and again today. So this is complex stuff, and I really appreciate you all making yourselves available so often to help us through it. And with that, folks, we're going to end the call. I hope you all have a wonderful afternoon. Bye-bye.
Bye-bye.
Bye now.